I'd like to thank everybody for joining me today. Today, I want to talk about charitable planning options. As we start coming into the year-end planning, this is a good time to revisit this topic so that we can make sure that we're including this in with our clients to see if this is something that can help them achieve their goals. When you start looking at charitable planning, one of the big questions that comes up is what assets can we give to charity? And if you look at this list, and it's not an exhaustive list, you can give cash, you can give business interests, securities, real estate, you know, oil and gas interest, part of your retirement. All of these assets, if you've got a capital asset, those can be given to charity. So the list is extensive. The question is, which ones make sense for you as the client? When you start looking at what we can give, now let's start talking about how we give. And we'll go easy to more complex here. The easiest thing is just to give a direct gift that, you can transfer property from you to a charity. You get a tax deduction. It's very straightforward, very easy. What I do see is things that probably should be done better. And if you think about this, most people will just say, I'm going to give, write a check or transfer cash into that charity and take the tax deduction. Well, look over there. Do you have appreciated investments? Especially stocks, bonds, mutual funds. Take those, give those to charity, because now you get a deduction for the full fair market value. You don't have to recognize the gain from that security. Take that deduction, and if that's your favorite stock, then go buy the stock again with your cash. Now you've got a full new basis in that. And you've made that direct gift even a better transfer than it is just giving cash. The next thing is looking at qualified charitable distributions. I like this because I talked to a lot of clients that did a great job building up their retirement accounts. Now they've got required minimum distributions and they're saying, I don't need the money. I don't want to take that extra tax. Well, now you can distribute from your IRA directly to the charity. Now, you don't get an extra tax deduction, but you get to not recognize this as income. So it keeps your income lower, keeps your taxable basis lower. So to do this, it has to be an IRA. You have to be at least 70 and a half years old. The max you can give is $105,000 per year. And it does count towards your required minimum distribution. So this is a good way to take that retirement asset, move it to charity. Don't have to recognize the income from taking from your retirement account, but you don't get the extra charitable deduction either. So it's a win-win because it keeps your taxes lower and you get to give something to charity. The next one I like to look at is leveraging our assets for charity. A lot of times I'll see, clients that have money in CDs or savings accounts. They're in these very safe buckets of money, but they're really not, they don't have a purpose. They've got money sitting in that account because they don't know what else to do with it. Well, we can take that money, take it from the CD, and if we have to, use a premium deposit account to spread this out so we don't create a modified endowment contract in the life insurance policy. But now take that money and move it over into the life insurance policy. What I like there, it's going to create death benefit leverage, and we can keep cash value growing tax-free inside of that life insurance policy for all of those what ifs. What if we need money for our business, for long-term care, for trips, for gifts, just to do whatever you wanted to do to maintain that lifestyle? All of that, we can have tax-free access to the cash value of this policy. If we need to add chronic illness or long-term care riders into that during life, great. Solves another need that our clients may have during their retirement years. But now they've got access when they need to, how they need to, and for whatever they want. When they pass on, they're going to generate that death benefit. And part of that death benefit can go to charity, and part of it can go to their named heirs or beneficiaries. And what I like is we've leveraged the death benefit gift to the charity. So think about this. We may have a CD of $100,000 that we're not using. We don't really know what we're going to use it for. It's in there as cash value if we need it, but maybe the death benefit, and let's just use an easy number, it's $200,000. Well, our heirs were going to get 100,000 anyway. Now we can pass that tax-free death benefit to them and give another 100,000 to our favorite charity to do the good that they can do. So it can be a win-win for the family, for our clients, and for the charities that they love. And all of that, if it's done right, can be done tax-free under the tax code. Now let's look at charitable giving plus. Can we do more with this? And the first thing I want to look at is charitable remainder trust. With a charitable remainder trust, we're going to look at appreciated property. This is appreciated property, and we're talking to our client before they sell the asset or before they've already signed documents to sell the asset. And number two is the assets that we're looking at cannot have debt on them. So think about this. It's an apartment complex. It's a rental home. It can be a business. And we take that, we get a value, get that asset valued, get a tax appraisal done. Our clients move that asset, and let's use a business. They move the C corporation stock from them and put it into the charitable trust. When they put that in, they get, do that at fair market value. They're going to get a charitable deduction today. And that charitable deduction is going to be the present value of the remainder interest of the income they're going to receive for the rest of their life. So we'll talk about that in a second. Now, with that stock inside of the charitable trust, the trust can sell that stock, can sell that business, and reinvest that into portfolio income assets. And now with that extra money, they're going to generate an income stream back to our clients for the rest of their life, joint lives, set number of years, whatever they want. So think about this. They put $1 million business in there, and they're going to take a 5% annuity payment back every year. So $50,000 a year for the rest of their lives. And they've got that reinvested now. And so the charitable trust has been able to sell that in a tax-free environment, distribute that income, and create that charitable deduction. When it's all said and done and our clients have passed away, now whatever's left in that trust can go out to the charity. So the charity doesn't get anything until our clients have passed on. So it's a good way to create a charitable deduction. It's a great way to create lifetime income. And it's a great way to move assets onto our favorite charities. Now, we add on to this, if you've moved assets out of your estate that would have normally gone to your heirs, now you can do a replacement life insurance policy to replace that with a life insurance policy back to your kids. But the life insurance policy now is going to pass to the kids' income and estate tax-free if we want it. The reverse to this is a charitable lead trust. Now, a charitable lead trust can happen after the sale. And with a charitable lead trust, think about this. We're going to reverse positions here. Our client's going to transfer assets into the charitable trust. The trust now can reinvest those assets, but it's not in a tax-free environment. And that's a key to a charitable lead trust. Charitable remainder trust, anything that happens inside the trust is tax-free. Charitable lead trust, we don't get that, but you'll see why. When we transfer that in today, we get our client gets a big tax deduction. Now, the annuity stream goes out to the charity. So we're going to say we'll give them that 5% for the next 10 years. So they're going to get $50,000 a year in our example for the next 10 years. So over a 10-year period, the charity gets $500,000. At the end of this period, whatever's left in the trust now comes back to our clients, and they can use that as part of their retirement plan. They can use that as part of their estate planning to pass on to their kids. But all of this, whatever's left, comes back to them, but they got the charitable deduction up front. So with charitable planning, just think about with our clients, do they need a tax deduction? Do they have a favorite charity or charities that they would like to benefit? And with some additional planning, it can be a win for the family, it can be a win for our clients, and it can be a win for the charity. So think about this and make it as part of your planning. If you have questions, feel free to reach out. If not, we'll talk again next week. Thank you.